Thanks, Tanya. I'm going to talk hopefully for about 50 minutes and then 5 minutes at the end for questions. So prepare some easy questions for me. That'd be nice. Thank you very much. Tom Hall, Chief Economist of Barbour ABI. We research planning information, provide intelligence services for what that means for construction. So so what I'm going to talk about to you today is going to kind of give you a brief overview of the UK economy as I see it, the major risks, quite a few at the moment. Talk a bit about the consumer environment, and then delve into kind of construction specific stuff. So about construction output and what's generally going on for overall in construction, and then talk about a bit more about what's going on that's sort of maybe a bit more specific to the FMB's members in terms of smaller projects and smaller building and things like that. And then hopefully tie it all together for you in a nice outlook at the end. So see how this goes. So probably, this works. There we go. So by way of an introduction, just talk in general terms, obviously post-COVID, coming out of post-COVID 6 to 9 months ago or so, things were looking up in general for the economy and in general for construction as well. So that post-COVID bounce, as restrictions were removed, we started to see an unwinding in the economy and what have you. Unfortunately, with the cost of living crisis and everything else going on, invasion of Ukraine, significant uncertainty now, and I don't think anyone really knows what's going to happen at all. If you look at the various economic forecasts, they're just all over the place. So I'm going to give you my view. You've probably got your view, and that's that really at the moment. So going to do what I can. Obviously, next year, recession, highly likely, and when an economist says highly likely, it's probably fairly nailed on, I think. And as I've already kind of intimated, the predictions are very difficult at the moment. However, construction so far at least has held up pretty well in the face of everything going on. And I think the underlying demand that remains in construction is probably a theme we're going to come back to over the course of the presentation today. So first real slide of note. So the graph on the right hand side is our forecast of GDP. This was done before the Bank of England's most recent doom and gloom report, I think back end of last week. So it's fairly similar, it's slightly less pessimistic than the Bank of England, but broadly GDP at the moment, our view is that it's likely to fall by, somewhere in one point something % next year, and then a pretty anemic recovery in 2024, 0.678%, if my memory serves. Can't remember the exact numbers, I'm afraid. But yeah, I think that generally among quite a lot of the forecasts at the moment is that impact next year and that anemic recovery in the wider economy, because you've got all these factors that are going to continue, and as well the Brexit trade barriers and everything else is going to hold us back from export-led, which is generally the easiest way to recover from things like this, export-led recovery. So external factors obviously causing the global slowdown. The cost of living crisis is being caused by a mixture of things. So obviously China's approach to managing COVID has caused lots of disruption to global supply chains. Got obviously Russia's invasion of Ukraine, which has just disrupted things hugely, particularly energy, and then also other things as well. So we're starting to see climate change impacts really being seen, for example, starting to hit food prices and things like that, as well as uncompetitive markets and an element of price gouging, and also an element of future speculation as well that's hitting forward prices as well. Unfortunately, the UK's, in my view at least, is likely to be the least shielded from the impacts among major economies because of our reliance on energy imports, our reliance on food imports and things like that, as well as obviously the trade barriers which we erected as part of Brexit. Inflation of more than 10% this year and potentially continuing into next year. Broadly, it looks like it's going to result in about around a 4% reduction in real income this year and probably next year as well. The Bank of England raising its base rates. I'd put mortgage rates to double if the base rate hits 5%. Some strong words from the Bank of England last week saying it's unlikely that they're going to go that high, but even so, the relative increase is obviously for a lot of homeowners is huge. And it's the relative increase in mortgages that is going to cause the pain. As well, since the Brexit vote, flatlining business investment, which has held back our commercial sectors, and the trade barriers that I've already talked about. And then finally, sorry to keep on massively doom and gloom, a return to government austerity again will hold us back if depending how bad it gets. And that's obviously, I think, the big unknown for me is how much austerity we're going to have. It's going to be imposed in the November statement, and as well as maybe the economy starts to go downhill, what emergency support measures are going to be put in place to help homeowners, to help the wider economy, maybe some of the impacts that we might see. However, there are some positives, and I'll try and dwell on the positives. In that employment does remain very tight. So it's a very different case to where we've been previously. So, like generally, when you have an economic downturn, knocks into employment, and then you start to see a downward spiral. So once unemployment increases, then it's often issues persist for longer than you expect. With the employment being very tight, hopefully we won't see the kind of increase in unemployment that we have seen over previous crises. Consumer spending has held up better than expected so far, very positive. Lots of lockdown savings, certainly among the more affluent income groups as well. So positive there. And as well, the energy price cap hopefully, or certainly will, offset some of the inflationary issues, particularly and avoid some of the affordability issues, particularly some of the severe ones. However, continuation of impact into 2024. I feel like I took up too long on that slide, but a lot to talk about, obviously. Here we go. Slide on inflation and shortages. I'll rip through this. So the graph on the right-hand side, impossible to really understand, I think. Well done me, but so the light blue line is construction materials price inflation. Left-hand graph. The dark blue line is average weekly earnings, and we'll change estimation on the left-hand axis. And then the dark purple line even is construction vacancies and absolute numbers, which is the right-hand axis. So please don't try and understand it, but I'll try and explain it. So in terms of materials inflation and shortages, obviously remain a massive issue. Started to hopefully see a bit of an unwinding in that in construction, at least. The phases materials inflation start to show some signs of softness, particularly for some areas. However, still running I think the most recent one was something like 18% annual inflation, down from about 25% at its peak. However, I think the annualized since the increases that we saw in materials prices, I think we've seen something like a 40-something% increase overall on average, which is a massive amount when you think about the stability that we had previously. Structural steel, timber, reinforced concrete, and finished goods have obviously been some of the main culprits over the last 18 months or so. However, I think more recently we started seeing other materials come to the party, most notably in insulation for obvious reasons with the energy crisis and what have you. So I think continuing supply shortages, continuing materials inflation and things like that as well. I think just the new normal for the short term at least. And then finally, obviously vacancies. Vacancies has been around 50,000 at least since the middle of last year, particularly in London and the South East due to the fall in migrant labour. However, we're not seeing really significant wage pressures in particular. So pay inflation running around 5% and has been for quite a long time. There we go. So a brief slide around the wider construction industry. So the graph on the right-hand side, again, pretty impossible to probably understand. Thanks, well done me again. But that is construction output by sector. I think we'll kind of talk in general terms around this, but construction output returned to your kind of late 2019 levels, which was when it was highest previously, because it dipped a bit before COVID, in early 2022, and it's been broadly flat since then, which is good. But coming out of COVID, we've seen a very different sectors performing well and others very bad, others very differently compared to pre-COVID. So broadly, infrastructure has been holding the industry up. new work, and also repair and maintenance, and also private housing R&M, which we're going to talk about in more detail in a bit. Whereas we still see, your commercial and your public housing remains well below pre-COVID levels, and your residential house building and things like that kind of bumping along a bit higher than they were before. Recovered kind of steadily post-COVID, which is good, but again, not booming, shall we say. And thinking about the planning environment as well, obviously we collect planning information, so we're relatively hopefully well placed to be able to say what's going on in the planning environment. So we experienced a 25% annual gap in contract awards over COVID, which was a big hole. We've seen really strong recovery in contract awards over 2021 and the new all-time record in Q1 of this year. And then, however, we've seen that fall with the cost of living crisis and what have you, back to average levels, more average levels. So not a terrible story in terms of forward activity, in terms of larger projects at least. But we have seen kind of falls in those commercially sensitive sectors, because it's always the commercially sensitive sectors of house building and offices and things like that, which see the impact. And again, forward activity looks like it's going to be held up by infrastructure and obviously warehousing, like massive demand for warehousing as a result of obviously the online purchasing boom, and as well demands with Brexit and what have you, and the disruption of supply chains and the removal of just-in-time manufacturing. Everyone's rushing to warehousing, so loads of warehousing activity. So the last slides that I've got for you really are taken from our small planning information database. So we've been working this year on improving the insights that we can derive from our small planning. So I'd hoped to do something on small house building, but unfortunately the algorithm that we've got to do that isn't working yet. So it's just going to be home improvement, I'm afraid, today, which hopefully will be useful. But so the graph on the right-hand side here is planning applications indexed, obviously, by kind of group by major sectors. So the light blue line is all home improvement. The kind of mauve line that you probably can't see that follows the purple line is internal improvement, so things like kitchens, bathrooms, etc. Redecoration. Your dark purple line is your external stuff, so gardens, all those things, garages, etc. And then more space is all of your extensions, loft, all that, those kind of things. So as you all know, we saw this bow wave of home improvement over COVID pandemic. You can see that in the graph massively. Went up by probably 30%, at least from kind of pre-COVID levels, and probably more like 40-50% from your lockdown levels. 50%, I would say. So unprecedented in terms of, if you look at the time series back the way, unprecedented increases in activity. People had savings because they weren't able to go out and spend their money on whatever they do, and everyone reassessing their living requirement, with everyone working from home, reassessing what they wanted from their houses and things like that. So that happened. However, since then, we've naturally seen, and also due to the economic circumstances that we seen a pullback. So again, you can see that quite clearly in the graph. After that boom in kind of early 2021, fell back quite significantly back to more normal levels over the remainder of 2021 and into 2022. But then in the last quarter, we've seen a pretty significant pullback, almost down in some areas down to kind of lockdown levels. I mean, there was always going to be a fallout, right? So when you see that bow wave, generally you see the opposite impact, because people have brought forward what they were going to do. They've always wanted to do their kitchen, they've always wanted to do their bathroom, whatever. They now have the savings to do it, and so then you're going to see the respective drop. But I think that graph probably speaks for itself in terms of you can see the kind of economics, the wider impacts coming through there, hopefully with the tick up and then the fall back down as cost of living crisis, etc. is bitten. We've seen a greater fall in your more space stuff, so your extensions, loft, your basements, maybe your higher value things proportionally than everything else. So internal and external improvement holding up better. And then regionally, obviously London and the South East remain by far the biggest the biggest regions in terms of home improvement, in terms of numbers and value, but they've been much more hit by COVID. So proportionally, the percentage falls have been much more in London and the southeast, and much less, or rises and falls, I should say. So the rise in lockdown and the relative fall afterwards, the London and southeast saw a smaller increase and then a bigger fall, and other regions, particularly the Northern England, Scotland and Wales, saw a larger increase over COVID, and then a smaller fall post-COVID. So generally it's North, Scotland and Wales seeing the highest growth, but in absolute terms, London and the South East remains the biggest market by a walking long way. Talking about some of the changes that we've seen in activity as well over COVID and more recently. So I've got two graphs here. So the top one is looking at some of the changes that we saw in COVID and how they've changed over COVID, but also what's happened since then, and then also where we're seeing growth, as you can see. So it's things in the sustainability and energy efficiency arena where we're seeing sustained growth. So in terms of the changes that we saw over COVID, so obviously we saw a ton of home offices. So we saw about a 300%, 3 times more than that increase in home offices. We saw a lot of external work, so garden work, swimming pools, things like that, as well as roof works as well. Big increases in there as people reassess their living requirements, things like that. Quite a lot of, so if I pop back, so a lot of these things have fallen back to previous or very low levels, so your general stuff like your kitchens, your bathrooms, etc. But other things, these are the things which have maintained, remain higher than they were pre-COVID. So obviously home offices remains twice as many home offices as pre-COVID. So we're seeing twice as many applications come through for home offices as we saw pre-COVID. Seeing 40% more swimming pools, so that external activity and things like that. But we're still seeing garden works remain. It's probably more actually swimming pools, something like maybe 50 or 60%. Garden works still 40% above where they were pre-COVID, and roofs still above 20% above pre-COVID levels. So seems to be some structural changes. So people just remain to be reassessing what they want out of their houses and what they value in terms of their kind of living requirements. The other big part is obviously energy efficiency and sustainability, even more important since the energy crisis and what have you. Excuse me. So of that, we can break it down. So we only pick up this stuff when they're on a planning application. So we don't have full coverage. So the numbers in absolute terms do not cover the whole of the UK, but you can certainly see the trends. And the trends come out very, very clearly. So solar panels, 400% increase compared to 2018 and 200% increase since 2019. For example, EV, 200% up since 2019. Heat pumps, 150% up. Insulation, 100% up. So all of these things massively increased compared to a few years ago, which is good news, and obviously very necessary given the level of price increases that people are seeing and the general low standards of energy efficiency of our housing stock. There's also less regionality also in this data as well. So I haven't properly looked at it yet, or properly thought about why. Potentially, I guess, just thinking out loud here, almost due to income potentially. So you need 20, 30, 40 grand to be able to install to greenify your house. So potentially more demand from the southeast and London, what have you, or sun up there compared to north, down there as compared to north as well. So it's less. There's less. I guess the north and Scotland and Wales and what have you are seeing. Not seeing those increases compared to the south. It's more just spread around the UK. Final slide, briefly on this. So commercial activity is subdued, unsurprisingly, shall we say. Obviously, very difficult trading conditions over COVID-19 in the wider economy, and since then. So we haven't seen any post-COVID bounce in application numbers across the commercial sector, which is small commercial, obviously. merely the resumption of the previous generally downward trends, unfortunately. So positive, no falls in your ventilation and air conditioning stuff. However, most other things, so your retail stuff, your shop fronts, your signage, your lighting, all remain on a downward trend, and some of them have taken a very long time to return to the pre-COVID trends. So, for example, signage and shop fronts took 18 months to return. So, a long way back for the commercial section. Obviously, likely difficult times ahead next year, unfortunately. So, brief on that. So hopefully I haven't run over. There we go. So final slide, bit of a whistle stop for today. So summary, most of my doom and gloom thing. So Bank of England on Friday suggested that the level of shock the economy is about to go through is greater than what we had in the 1970s. But who knows, frankly. I think it is concerning, obviously, the state of the economy going into next year. But there's a very wide amount of possibilities at this stage remaining. However, underlying demand for construction obviously remains strong. Both for larger projects and smaller projects, you can see the underlying demand over the long term there. But the bigger stuff, infrastructure, the warehousing, healthcare, likely to hold up the industry over next year and next couple of years. Particularly, the worse the economy is looking, more quickly, commercially sensitive sectors of residential and commercial, offices, retail, etc., and industrial, the more quickly or more harder hit it will be. And we've seen that time and time again. But those sectors generally should be less impacted, definitely less impacted by the prevailing economic conditions. As I said before, you're levelling down your austerity, removal of levelling up stuff, and a return to austerity, a major risk, and we'll just have to see what happens next week, I think. However, there is the opportunity for more government support, depending how bad it gets next year. And then all of the issues that all you guys have been dealing with, again, sorry to be a bearer of bad news, but likely to continue at least well into 2023 at the very minimum, I think. Your materials and product information, supply chain issues, not going away anytime soon. China doesn't look like it's changing its approach to managing COVID, for example, although there were some rumours last week that it might be. And those labour shortages are likely to continue, particularly until something changes on the policy front. And already we're seeing that increased margin pressure due to already it's ongoing and potentially will continue due to increases in cost and things like that. And finally, for the smaller projects, so I think fingers crossed, fingers and toes and everything else crossed, that the bow wave of COVID projects we saw over COVID will at least hold up output over the short term, because there's now a backlog of projects that are in the system that are waiting to be done. So activity should continue. That forward order book though might start to look slightly sparse. However, there are major growth areas as demonstrated. So your energy efficiency stuff, some of your external stuff still continuing, and obviously I think given the relative impacts distributionally across the country, generally your higher income groups have been somewhat more insulated than your low income groups. So the demand for your higher end stuff, the demand for solar panels and stuff like that, and your higher end home improvements and small build stuff will likely to be less badly hit at least, and maintained more as we go through the next year or two, because it looks like looking where the cuts are likely to fall and where taxes are likely to be raised from, higher income stuff, people still likely to have some spare cash to be able to do that kitchen or whatever. So that's it from me. Thank you very much for having me.
Thank you so much. Nothing is not comprehensive. Just stay where you are if you wouldn't mind. And if people want to ask questions, then now is the time to do so. One of the questions that was popping out to me is what the Bank of England has said about the 1970s shock. Now, nobody in this room is old enough to remember that. However, one of the things that affects people, if it's a short-term shock and they can kind of see the other side of it, then people will get on with it and plan accordingly. The danger is if it goes on for a very long time, isn't it? And inflation is the inflation
inflation is the killer, right? So
right. So what I want to know is there a point of inflection for inflation in your forecasts?
So I think our forecasts assume a general a decrease in inflation from, I think, Q1, Q2 next year.
Right. Yeah.
Back down to around kind of 5% on average over 2024. So which I think is slightly more pessimistic than some of the forecasts.
What does that depend on? What markers are you watching?
So well, I think
Russian gas.
Yeah, well, I think it's not. There isn't. I mean, you know, you kind of look at forward prices of things and what have you. And it's very difficult to say, oh, I can see the bottom falling out of this market at whatever time. You know, the fuel prices fell quite significantly from their peak earlier in the year, and now they're going back up again. So I think it's very, very difficult to see, almost impossible to see the future right now. I think it's more the qualitative view around how long do we think the Russian invasion can sustain itself for? How long do we think China is going to continue its policies with regards to managing COVID? But I think we've come out of a period of very low inflation for a long time, and I think that period has passed. And so I think, you know, generally high inflation is probably the new norm. So I don't know where that's going to stabilize at, but I think a return to 1-2% inflation just doesn't feel like a particularly reasonable scenario at the moment.
Okay, fine. Yes, please. Would you say your name and where you're from, please? And I'll ask the question.
Thank you. Polly Martin, I'm Head of Policy and Communications for the Heritage Alliance. We're a membership organisation for any people working in the heritage sector. So many of our members are builders or are involved in construction in other ways, for example, commercial archaeologists or trades and craftspeople. I was wondering about some of the information data sets that you have. Does that also take into account, for example, the list of building applications reflecting planning data? Because obviously, with some of the things you discussed here, there's an additional layer of cost for works to listed buildings, and particularly from what you were saying about income brackets, although it's not something you can say across the board, but generally, people looking after listed buildings or living in listed buildings tend to have high income brackets as well. So I'd be interested to know if there's any information that you have on that.
It's a great question, actually, and something that I could have mentioned in my talk, in that we have seen, so we do track listed building applications, and they are significantly higher than pre-COVID levels remaining, which could have been one of the things, if I'd been intelligent enough to mention that when I was talking about, that's one of the things that has kind of led me towards the belief that higher income groups remain less affected. You know, that the amount of lockdown savings that they were able to accrue, probably a higher proportion remaining, and generally being less impacted by tax rises and things like that proportionally. So yes, we do follow listed buildings, and they remain significantly higher than pre-COVID levels. Thank you.
Thank you. Yes, please. There's two questions. If the gentleman with the coffee on, I don't think you need a microphone. I think you just shout.
I'm very happy to shout if you're happy to listen. I'm Chris Bateman. I run a trade. It's one of the things I do. I run a trade association of people who make insulated steel panels that go onto warehouses. So yeah, we're flying.
Great.
But a very simple question from your first slide.
Yes.
You talked about increased consumer spending, or consumer spending have held up.
Yes.
I wonder if you have any sense what unsecured consumer borrowing looks like.
Unsecured consumer borrowing.
Yeah, in other words, are they putting it all on the credit card, or is it coming out of savings?
So you're worried that there might be it might suddenly fall off a cliff because people will be over indebted.
The trend in credit card borrowing has been consistently up.
Yeah.
Yeah, for like 15
There's a lot
years.
of buy now, pay later stuff, Klarna and all of that. There's a lot of buy it now, pay later, or pay in installments stuff, Klarna and stuff.
So there's a lot of people who are just paying the minimum amount.
Yes, yes.
So I just wonder if you've any sense.
I've been kind of keeping one eye on it. So the thing I did notice more recently was that it looks like saving rates have increased. which implies that people are starting to kind of reduce their spending and increasing their saving in the expectation of hard times ahead.
Okay.
So that's one thing that I've noticed recently. I haven't been keeping, to my chagrin, I haven't been keeping a huge eye on the kind of short-term debt levels and things like that. But yeah, I think it's generally been increasing back. It went up to pre-COVID levels, like pre-COVID, post-COVID as it were. And I think it's been relatively stable and generally on a slightly increasing trend by then, before then, but hasn't been exploding.
Okay. Thank you.
In my view, but yeah.
It's a really important thing to watch because that actually was a very early indicator of the financial crisis. Exactly that, those levels.
Yeah.
Yes, please. This lady in the blue, yes.
Hi, I'm Juliette Phillips from E3G, which is an independent climate change think tank. Thanks for the presentation, but it was very encouraging to see the high levels found for the sustainability improvement. I think my question is around the whole supply chain issue. It seems to keep coming up, and I'm not really sure what the solutions are, and whether you've seen any countries around the world doing a good job to address that, which the UK might want to kind of take some lessons from.
I think, well, the issues are global, so there's a lot of issues. So, and some countries have been particularly hard hit for a variety of factors. So, for example, a lot of German industry has just had to close because it hasn't had the just hasn't been able to source the power. It normally usually just has got used to importing all its power from Russia. So there's a wide variety of impacts occurring. I think, and yeah, lots of countries highly impacted. I think, as I mentioned, I think the UK has been is blame Brexit here. You can probably have my view on Brexit, infer my view on Brexit as a result of this. But I think it's a mixture of the trade barriers that we have. We're already we import a huge amount of our energy supplies. We import a huge amount of our food as well, which makes us very liable to any external shocks. So external shocks are likely to impact us more because we don't have that kind of, we're not internally sustainable. As well, the fall in the value of the pound, and everything is more expensive. Again, long term due to Brexit, so you saw that fall in the value of the pound due to Brexit. Investors view that the UK is less good to invest in as a result of Brexit, and then obviously the more recent developments as well have obviously impacted. And then just generally, the trade barriers that have already come in as a result of Brexit and are remaining to come in because a lot of the legislation hasn't been enacted yet still, or the bits and pieces with regards to checking and monitoring imports and things like that haven't come in yet. So all of those things kind of contributing, as well as I think that that I think we've sold off a lot of our storage for natural gas and things like that, which again means we can't insulate ourselves against price shocks. So sorry, depressing answer to that question.
Well, on that note, unfortunately, it was closed. Tom, thank you very much. Despite your very self-deprecating attitude towards contribution, we're very looking forward to very intelligent, very insightful.
That's great. Thanks very much.
Thank you.